And it's true what we're looking for is top-line revenue growth because that means that demand is picking up. Although profit margins are still healthy because costs have come down, but I think at the end of the day, what we'll need to drive the market up is for that demand to show an improvement. The good news is, we're still early days in the results announcement, but so far, 62% of the results have been released in states have actually shown top-line growth. So I think that's one of the reasons for the bounce in the U.S. markets last night as well, is generally the earnings have generally met or exceeded expectations in that case. The other thing is that there's a very low base of coming out. The 4Q is when basically the global economy shut down. So when you're talking about the next few months' data, the actually year-on-year numbers are going to look a lot better than they have, so far. So I think, if nothing else, I think that's partly built into expectation. But it's nonetheless, because the top-line headlines are going to look better, that's going to be a confidence booster. That's one of the reasons why we think the market will probably run up a bit in the short term. As I mentioned, I talked about China loans growth recently, and that's what it looked like. Huge spike in June was because of lending by the provincial banks, smaller banks. If you look at the listed SOEs, like ICBC or China Construction Bank, they were actually a lot less exuberant. They really didn't lend to that extent. And I think that's one, as so far as the provincial banks, if the new loans can come in a little bit, the growth can be more reasonable. I think the government's going to be more comfortable there as well. So they are going to remain a little bit accommodative. So less negative rhetoric for the time being. Anyway, the Shanghai index has corrected to, I think, a more comfortable level that the government is probably a little bit more comfortable with as well. So as I mentioned, the data is going to be good in the near term, and that's going to trigger, I think, some legs for the current run-up in the marketplace. Now, the worry that we have is actually next year. And we think that next year is going to be quite difficult and quite challenging. If we look back in historical terms, the 70s, and then, as David mentioned, the 2000 earlier this decade, you'll notice that on the first year after hitting bottom, markets have a very good run-up. For the KLCI, generally plus 40%. The second year is where it becomes much more normal returns, in other words, single-digit upside. In some cases, the markets come down from their intermediate peak levels. So we wouldn't be surprised to see that sort of thing happen. What we're worried about is some shrinkage in the liquidity front. Even though the Fed may not tighten interest rates until the middle of the year, and we don't expect them to actually raise the Fed funds rate until then, the thing is that they're actually going to stop buying assets by March. So that actually means that they're going to print less money in that sense for the banks there. So that, I think, will be a natural sort of liquidity shrinkage. As far as Asian central banks go, we wouldn't be surprised. We're actually expecting, for the most part, between a 25 basis points to 75 basis points increase in interest rates next year. Most of it probably in the second half, but we would not be surprised to see the initial run-ups in the first half of the year, or increase in interest rates in the first half of the year. We've already seen the RBA and the Bank of Israel were the two that have raised rates first already. Having said that, we think a 25 to 50 basis points rate hike is probably absorbed or discounted in the market already. What will happen? We're more concerned about the stoppage of the asset purchases. Okay. So what are the risks? A lot of people ask whether it's a W, V, whatever. Our base case scenario, as I mentioned, is an excited U. The W actually doesn't look too different from there, because a W would be 2 positive quarters, but the positive quarters are very small on the positive front, and then followed by 3 negatives. And in our expectation, the negatives are going to be fairly minimal negatives. So it's still going to be like a U on the heart machine, defibrillator. So with a few bumps and squiggles. What will trigger a W case in our viewpoint? Another financial crisis thing in the States potentially. Whether we don't think it's going to come from credit card defaults, because I think that's provided for and factored into the cost of the credit cards and the default rates have been within the norm so far. Where does it come from? Commercial real estate. So far, yes, that's a big negative for the U.S. banks, but it's mainly affected the smaller regional banks in the States. Close to 100 banks in the U.S. have failed already, but you haven't seen the extent of the impact to the financial system as what happened in September last year. So they've been able, so far so good. I mean, they've been able to absorb the fact that smaller and more regional banks have been the ones suffering. Now, optimistic case, I don't think that's going to happen. Sorry. So we're still sticking to our base case, which is slow recovery. The optimistic case means that the U.S. consumer is going to, resume spending, but I don't see that happening because the baby boomer generation is actually past their peak spending age. So unlike the 70s or the 1990s, unfortunately, you don't have that leg to depend on. Okay, so what's the worst case? An L, which is Japan, bear market for 13 years. Hopefully that doesn't happen, but we won't rule it out for now. And the only good news on that front is that, of course, Americans don't save like the Japanese do. So we do expect them to consume eventually. Okay, all right, thank you.
Thank you, Lorraine, for that. Next, we have Julian from Arab. I think he's the fixed income specialist, but he'll give his views on where are perhaps the opportunities. Thank you.
Thank you, David. Good evening, everyone. Actually, I got a shock when I came here. I was told I'm given only 10 minutes and I have to speak on global fixed income outlook as well as derivatives and hedge funds. So okay, I will try to go as fast as I can. I'll try to be brief, but I'll cover everything, hopefully. Okay, now if you look at the glass on the table over there, water has been poured in. Okay, it's a matter of seeing whether it's half filled or half empty. Right? Now, it seems as though the data out so far is suggesting that the cup is half filled. Okay, we are seeing renewed optimism in the global economy. We are seeing Global Purchasing Manager Index all going up, higher, right? We are seeing some recovery in the US, Europe, and China. And to add to that, the IMF has actually upgraded its outlook on the global economy for the second time. Okay? It is calling for world GDP to grow by 3.1% in 2010, slower for developed markets, but 5.1% for emerging markets. Now, that is a good sign. That is actually half filled for our glass. So if you look at the chart here, this is actually the GDP, the world GDP as well as GDP of the advanced economies and emerging economies. You see a V shape. Sorry, the laser isn't working or it's too far away. Okay, anyway, you see a V shape here, right? It dips down globally and it's up again. Now, it is a good sign. However, from an economics point of view, this recovery here is very, very steep, right? When the world economy came down, that was in Q3, Q4 last year, the pace at which global economy recovered in Q1, Q2 is too fast. So what we think is that it will go up slightly, but it will taper off, and it will remain there for a prolonged period, right? So this is the part where we see the glass as being half empty going forward. Half empty doesn't mean that it's bad, but it means that growth will taper off for the world economy as well as for advanced economies and emerging economies, right? Now, if you look at the chart here, advanced economies and emerging economies, you see same pattern here, right? So the question is there decoupling in the global economy? Well, it doesn't seem so. If it is so, then advanced economies like US, Europe, and Japan dips down, but emerging economies will remain flat or should go up. So the fact that all charts point to the same direction shows that there is very little decoupling. So the key is, can emerging markets save the world? I think I would like to change the question to whether emerging markets can save themselves or not. Well, I would think yes. Okay, the lessons that we learned. See, the problem is that people in the US tend to think that the world is safe. So for the past 20 years, they say, oh, we are out of crisis. Hence, they coined the term Great Moderation instead of Great Depression. But if you dissect the world economy into subsectors, you see in the 1990s, there was a lot